Greetings to all viewers, I am Mr. X and welcome back to the X Show. Today we will be talking about CBDC, the FDIC, and financial market price updates. Before we begin, this video is not sponsored by anyone or entity. I have provided links in the description of this video as to what has been mentioned. Central banks are testing and thinking about whether they should substitute publicly issued digital currency for the bank-issued digital money that people use every day. How this plays out can profoundly reshape the financial system and make it less stable. While the conflict is largely quiet and out of public view, they are in the midst of a battle for the soul of the financial system. While some may be benign, the most radical version is one that is universally available, elastically supplied, and interest-bearing. This has the potential to trigger destabilizing financial shifts, weaken the supply of credit, and undermine privacy. Over the past century, a variety of forces gave rise to the financial structure we see around us. Through a combination of punitive taxes and outright bans, officials hinder the issuance of private paper money. Second, governments license private intermediaries, normally commercial banks, to issue liabilities that are convertible at par into central bank liabilities. The central bank runs a wholesale payment system for banks, while the private sector runs the retail payment system for the rest of us. Central banks are plowing ahead, often referring to motives such as payments efficiency, financial inclusion, and monetary policy implementation. There is a desire to supplant cryptocurrencies like Bitcoin. There is fear of missing out. Central bankers want to make sure that, if others issue CBDC, they can too, and without delay. This creates instability in theory. An unanticipated event could trigger many central banks to mobilize their digital currencies within a short period, so as not to be left behind. Before issuing retail digital currency, a central bank will need to make a series of design decisions. Is it an anonymous bearer instrument? Will there be quantity restrictions on an individual's holdings? Are only residents of the issuing jurisdiction eligible to hold it? And like paper currency, will it have a zero interest rate? For paper currency, we know the answers to these questions. It is an anonymous bearer instrument. It is supplied elastically to allow the conversion of certain bank liabilities at par into the medium of exchange without limit in as many circumstances as possible. Anyone can hold paper currency, and it bears zero interest. The likely characteristics of CBDC are equally clear. To avoid facilitating criminal activity, CBDC cannot be anonymous. To truly substitute for paper currency, it will have to be supplied elastically. This means if supply is perfectly elastic, it means that any change in price will result in an infinite amount of change in quantity. Individuals will be allowed to hold unlimited quantities. Otherwise, there would be circumstances when bank liabilities will not be convertible into CBDC at par. Restricting holdings to residents is a version of capital controls. There are two reasons that CBDC would have to bear interest. It is unsustainable for a central bank to pay interest on commercial bank reserve deposits, but not on the deposits of individuals. The issuance of such universal CBDC creates four critical problems: disintermediation, currency substitution, lack of privacy, and the inability to ensure compliance. Given the current high foreign demand for U.S. paper currency, imagine what would happen if the Federal Reserve offered universal unlimited accounts. The consequences of this could be catastrophic for emerging markets and developing economies. The fact that CBDC is not anonymous and is non-compliant with privacy regulations, everything you do becomes traceable. There are enormous risks in allowing governments to have this level of detailed information about your activities, which is concerning. So, why are central banks so intent on preparing? What is the purpose of such contingency planning? The problem is that central banks fear being left behind in a way that damages the interests of their jurisdiction. Their solution is to create a form of ready CBDC programs. The situation is analogous to the one prior to World War I, when countries prepared to mobilize rapidly for fear that delay meant losing a war. In the early 20th century, in the absence of trust, an obscure event in a far-off land tipped the fragile balance into war. In the current financial circumstances, the bad influences is a world of multiple CBDC in advanced economies that threaten financial stability stability domestically and pose a severe threat to monetary control in developing economies. There is no easy way out. There is little way to enforce the cooperative equilibrium in which no one introduces CBDC. Central banks cannot credibly commit to never issue CBDC. China already headed down the CBDC road. Others now view it as too late to resist. Even with full knowledge of the risks, they feel compelled to prepare. This is the height of insanity. Perhaps the best hope is that central banks will all proceed very slowly and try to get the design right. That would mean stopping well short of universal, elastically supplied, interest-bearing CBDC. Perhaps it is in fact a little too late. Recent meeting of the World Economic Forum spoke of global cybersecurity outlook. I encourage you to watch the video on their YouTube video. In a recent interview hosted by Kitco News regarding banks legally seizing your funds with chief market analyst at ITM Trading, talks about how Reg D and the Dodd-Frank ACT, which are supposed to protect banking clients, may allow banks to seize customer funds to bail in the bank in case of a liquidity crunch or financial crisis. One has to wonder about the Federal Reserve's monetary tightening and the looming debt ceiling, or how will the Federal Reserve implement a CBDC? I would love to see your comments on this. We are all told by banks that your money is available to withdraw whenever a person wants to withdraw money and is frequent. However, the opposite may be true. They have a program called perception management, where they manage the way you perceive things so that you move in the manner that they intend you to. They also create a distance between their policy and how you receive or understand them so that you don't understand it, that it is the central bank policy. Listen to this Oedo regarding an open discussion meeting of the FDIC Systemic Resolution Advisory Committee last year, November 2022.
I mean, it's a little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they have, I mean, they're going to be. And it could be an early warning signal to the FDIC and the primary regulators when these things happen. And there may be some other prices. This is similar to what Jay was saying in the market, that you can tell whether people understand who's going to be protected, who isn't going to be protected. It would be, I think, an interesting study to look at the evolution of market prices in a situation like March of 2020, for example, and see whether people understood what might happen.
I might go further than that, Don, because I think that you look at the evolution. I think we have to sit down and talk to long-term debt investors and make sure that they, as a stakeholder group, fully understand bank debt today is not what it was before. It is not principal protected by design. And I think that expectation. I like how you started off, Betsy, like it's all about expectation setting. And I think that is absolutely critical. If that doesn't hold, this whole thing doesn't hold.
We're dealing with a society where people are getting their information in tweets. There's just no patience, I think, for going through the elaborate and careful planning that has gone on. It should be there. It should be accessible when people need to know. But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out.
One may think we are in the midst of a financial and monetary collapse unfolding. In other news, financial markets are closed today. However, the crypto market stays open. After recent events following Powell comments and the SEC complaint against crypto exchange Kraken, Bitcoin is currently trading at 21,900, briefly tagging support zone 20,000. Market-moving economic data is expected to be released on Tuesday regarding CPI year-over-year forecast of 6.2% from a previous 6.5%, and core CPI month-on-month forecast at 0.4% from previous 0.3%. Considering Powell's comment on inflation, if year-over-year and month-on-month inflation shows a cooling down inflation, there may be a market rally for risk on assessed. Thank you to all the viewers and subscribers. If you watched this far, please like and subscribe to The X Show, and I would also like to see your comments on what has been mentioned. Looking forward to bringing entertaining information in the coming week. Thank you and enjoy.